with that. Thomas Hayes, our guest this morning, Chairman and Managing Member of Great Hill Capital. Welcome to the show.
Thanks for having me, Anne.
Tom, let's talk a little bit about consumer spending, which rose for the month of August. What were the key reasons for the spending increase in the report?
Well, I think you said it. The labor market has been strong. Now the new autos are coming in because the chip shortage is alleviating, so that's a positive thing. Most people viewed the CarMax debacle this week as a bad news. I view it as good news. It's bad news because as the supply of new cars comes in, that's been held up by semiconductors for the last year, the demand for used cars goes down. So that's a positive development. It shows the supply chain is alleviating. And just as used car prices are going down with supply, we'll see new car prices start to moderate and stop going up as well, which will also be good for the CPI numbers. I would say that, as you know, and the pessimism in the market has been absolutely palpable for weeks. When it gets that kind of pessimistic, I try to take a step back and look at the facts. And, the facts are September is seasonally the weakest month of the year, statistically speaking. And this week happens to be the worst week of the worst month. Sell Rosh Hashanah by Yom Kippur, which is next Tuesday. We'll see if that works out. So far, the Sell Rosh Hashanah has been right. We'll see if the by Yom Kippur works. But it does remind me a lot of the June lows when we were going into Q2 earnings, and people were very pessimistic. Just like today, analysts are saying estimates are going to come down 20%. And the exact opposite was true. Earnings beat estimates, and what you saw was not a downgrade of estimates of 20%, but a modest downgrade of 3%, which was very realistic. And I think going into earnings season, which starts in a couple of weeks, estimates are extremely low, plus 3.2% for earnings growth. Well, you have to keep in mind prices have doubled more than that. So, if you're looking at 3% earnings growth, what you're really saying is negative 3% real growth, and that just doesn't bear out when you look at the strength of the labor market and still the relative strength of the economy. So we're more optimistic, and looking at positioning, I think it could catch a lot of people off sides.
Tom, help us break down a little bit consumer spending on products versus services. The big talking point has been experiential demand for services outpacing demand for goods. Did we see that in the August report?
Well, that trend is happening, and that's going to persist. I mean, you saw it with Nike, actually, in their earnings. They couldn't get the inventory during COVID. Then the inventory came all at once, and now they're overstocked. And you're going to start to see, like you saw with Target, like you saw with Nike, etc., that they're going to start discounting some of this inventory to get out, which is disinflationary and deflationary. When we look at the inflation numbers, that we just got this morning, they're not very valuable because they're as old as 60 days ago. These are August numbers. They're backward looking. I'm not really interested in that. What I am interested in is the lagged effect of the commodity basket completely rolling over in June and staying down. What I am looking at is prices at the pump coming down for 3 consecutive months. What I am looking at is Case-Shiller home prices coming down, which are not yet reflected in rents and not yet reflected in CPI because of the way that it's calculated. I'm looking at these factors, and I'm looking at 5-year inflation break-evens, which is where the market has expectations anchored, and they've absolutely collapsed from 359 in March to 237 yesterday, and they're going to continue to go down. So, and I think that's why you're seeing futures hold up relatively okay this morning, on the basis of people know they're backward looking and they can see what's happening in real life.
Nevertheless, Tom, the Fed's preferred inflation gauge, which we've just discussed, the core PCE index, yes, it's backward looking, and yet it is the core metric that the Fed does look at to try to determine what its interest rate policy is going to be. So we've seen persistent growth in consumer spending. We saw the PCE index rise about 0.6%, surpassing estimates for the month of August. Yes, backward looking. But what do you think the Fed is going to do now in response to this from a rate perspective?
Well, the Fed has been chasing, it's like a dog chasing its tail. I mean, last September at this exact time, They had 2022 GDP estimates at 3.8%. They had PCE inflation at 4.2%. And they thought it was a good idea to keep the Fed funds rate at 10 basis points and call inflation transitory. Now you have GDP collapsing. We've just had 2 quarters of negative GDP growth. We're probably going to have a third. So if 2 isn't a recession, will 3 make the cut? We're going to find out after the election. PCE inflation is moderating. Inflation, if you look at the peaks, the numbers you're referencing, U.S. core PCE year on year was 5.3 in April. It's 4.9% for August. PCE price index was 6.8 in July. It's 6.2 for August. So they're coming down. And I think the Fed just needs to acknowledge they've just done 3 75 basis point emergency hikes going back to 1983, 88 some odd hikes. 75 were below 50 basis points. They did 3 emergency hikes in a row. They've got to see if the patient can recover before killing him with too much medicine. So we'll see if they come to their senses. Usually, policymakers don't until something breaks, like you saw in England. They had to go back in the market and buy gilts. In Europe, the ECB now is back into QE with Italy yields at 9-year highs. They're now back buying bonds. So I think the Fed needs to be a little more sensible here and acknowledge that they've continued to be backward looking starting in December 2018 when Powell came in and said we're going to put quantitative tightening on autopilot and crash the market 16% a few days before Christmas until he walked it back a week later after Mnuchin called the 6 major banks to bail out the market. So I think a little humility is in order. We all make mistakes. The key is to learn from them, and he needs to be respectful that what he's looking at is lagging data. And he's got to be careful with 2 quarters of negative GDP and a third on the way, if you look at Atlanta GDP, not to drive the economy off the cliff. That said, the good news is managers are already positioned for the apocalypse, which means any good news, like you saw this morning, Russia saying we're ready to talk after annexing 4 separatist regions. No one's positioned for any upside. Cash levels are the highest since the great financial crisis, since the pandemic lows. We all know the recession was in the rearview mirror. Everyone was looking, when's the recession coming? It actually had already happened. I think this time will be no different. And I think that any bit of good news, whether it's earnings, whether it's Russia, whether it's the Fed kind of walking things back or being a little bit more patient, and you could see some movement into year end on the upside, which no one is expecting.
Let's real quick just talk about China. Let's talk about positive news, which you've alluded to, which we always appreciate on a Friday. COVID lockdowns seem to be coming to an end. Chinese central bank is easing.
Yep.
We've talked about your positions in Chinese stocks previously. What are your thoughts now on getting exposure to that sector?
100%. I mean, the rest of the world is aggressively tightening. That will change soon, but not soon enough. But China has been aggressively easing, both on the fiscal and monetary side since March and even since November. They haven't felt the effects up until August because they had been in lockdown and repeated lockdowns, and that put a drain on consumer confidence. The last few weeks, they're being more sensible as we move into the China National Congress and Xi takes his 3rd term. The person he has in mind to succeed and run the economic show is very pro-growth. Very interested in stimulating consumption. So a core position of ours has been Alibaba. We've continued to buy down. If you do the sum of the parts, this thing is, they've got $100 billion of current assets. The thing is trading at $225 billion. Oh, and by the way, you get the fastest growing cloud business in the world. You get an e-commerce business, and you own a third of the largest financial services business in Asia in Ant Financial. But right now, pessimism is what it is. We like the opportunity moving forward, but you have to have a little bit of a stomach in the short term and take a 1 to 3 year view. And I think we're going to be extremely satisfied with the outcome.
Thomas Hayes, Chairman and Managing Member of Great Hill Capital, thank you so much for joining us.
Thanks, Anne.
This Friday morning.